Hello, everyone. Welcome back. And today is September 19th, 2024. And today is an important update. As we all found out just yesterday, the Fed cut the interest rate by 50 basis points. That was a pretty big move. It's been quite a while since we've had a move that big, really going back quite a ways here. And we also had one of the board governor's dissent, which hasn't happened since really 20 years or so, where they wanted to cut only 25 basis points, but Jay Powell and the rest of the committee decided on the 50. It was a pretty big move overall, and it's the right move in my view. I've believed for quite a while that interest rates are too high and inflation is pretty much in the rearview mirror by now. The CPI is inherently a lagging indicator, so what it says today is where we actually were a few months ago, and so the Fed really needs to skate to where the puck is going, and I think it was late, but better late than never, as they say. So 50 basis points, I think it should be a lot more. For example, I've shown in the past that the spread between the Fed funds rate and the 2-year yield has been one of the steepest in the last 45 years. That spread has gotten way beyond control at almost 150 basis points. And so ideally the short-term rate, which is what the Fed funds rate is, should be below the 2-year yield. And the 2-year yield is way below where the Fed funds rate is right now. So I think there's a lot more where that came from. But the topic that I wanted to talk about today is something that's kind of slid between the cracks because everyone's been so enamored by the stock market rally year to date, driven by AI plays like Nvidia. There's another bull market that's happening that doesn't get anywhere near the press coverage, which is gold. And so I wanted to spend just a few minutes here. It's not going to be a long presentation. This will be pretty quick. But what is gold communicating to us? I think gold is something that we need to pay attention to because it's such a unique asset class in and of itself. And gold is beating the market this year. And it's actually beaten the market over the past 3 years, cumulatively speaking, which is quite something to say because the last 3 years have been an incredible bull market in the equity market. So let's dive into one working theory, and I want to call it a theory. It's not a fact, but it is my theory, my personal belief. And so I just wanted to share with you some data that I've found that, convinces me of what my sort of take on what gold is communicating to us is. So let's get started on that. So here's a table that I just put together on the return of gold versus the S&P over different time frames. As you can see here, year to date, gold is beating the market, by 1.6%. It's basically been in line with the market over the past 1 year, which is, something amazing to say in and of itself because this has been an incredible run over the past year where the market's returned 33.5%. And gold is up 33.1%. So it's pretty much in line. But you can see that gold has beaten the market over the past 3 years. It's underperformed over the last 10 years. So the separation starts to happen as we go longer and longer time frames. Interestingly enough, over 25 years, gold has beaten the S&P 500. But that may be partially due to time frame bias. Because of the fact that, over the past 25 years, that takes us back to 1999. And, that was right at the top of the market in that dot-com era. So we had 2 recessions during that time period. So the time frame bias might be filtering into that. And you can see that because if you zoom out to 50 years, you can see the market's not even close to gold. The market is clearly, beaten gold by an average of 3.3%, which doesn't sound like a lot, but that's 3.3% compounded over 50 years. So over a 50-year time frame, that adds up to being a lot, right? But the point of this table is to show that gold has surprised over different time frames. Most people would not have known that gold has beaten the market over the past 3 years, and that gold has beaten the market over the last 25 years. But something is happening right now that I think is relevant. And I'm not saying that gold is the better investment than the S&P 500. It clearly is not over a long time frame. But over short to medium term time frames, gold can absolutely be a S&P 500 killer. And my goal here in today's presentation is to understand when gold really outperforms the S&P 500. Here's a chart of gold over the past 50 years versus the S&P. Interestingly, for a long time, dating back to 1971 through 1990 or 1991, gold was outperforming the S&P 500, and that spread really got to nosebleed levels, during that inflationary period of the 1970s. But S&P was, kind of holding its own. The market, even through that inflationary period of the 70s, really continued to rise. So that actually goes to show that even the S&P 500 has a little bit of an inflation edge in and of itself, which is, quite amazing to say. But you can see that the S&P climbed really during that entire time, the 70s, 80s, 90s. Gold actually did even better, but then gold went into a sideways stagnation now, for the next 20 years, really at the turn of that 1980s decade. Reagan came in and instituted a number of policy reforms, including tax cuts that really boosted GDP growth. And it was actually deficit driven, but you can see that gold, really got hit and went sideways for the next 20 years. It actually, went into a slight deflation in the late 90s, really when the S&P went parabolic. But, for 20 to 25 years, we had a period of sideways stability in gold and, quite a bull market during that entire time for the S&P 500. And then we got in a little bit of trouble here with, 2 recessions, one the dot-com bust and then the 2008 financial crisis. Gold, again, went on another big move up like it did in the 70s. And it's really been a bull market since. But then we went into that another period of stagnation, just like we saw in the 1980 to 2000. Gold went sideways from 2010 all the way up through pretty recently here, 2023. Right, we went into a sideways movement, even though it was down a little bit. We regained that that loss, but then it's really just a sideways move for the last 10 to 12 years. But then look what happened. Zooming in a little bit here, just over a 25-year period, look at what gold did. We regained the highs from 2010, 2011. But then, bam, we really started to take off here in late 2023 and really all throughout this year in 2024. So we're rallying alongside the S&P 500. So my question is what is this telling us? Right, gold is soaring over the past year and year to date. What could this be? What could this possibly be telling us? My answer to this is nuanced. A lot of people believe that gold is an inflation hedge, and a lot of people think of inflation in terms of the CPI, especially in recent years, as the CPI really hit the highest levels that we've seen in 40 years, going back to that 1970s era. But the evidence is mixed at best. Gold behaves very differently from the consumer price index. That's what people think of when we say inflation. But my data says that, the relationship has been mixed at best. There have been times, and here's a chart of gold year over year versus CPI year over year. And although gold has had periods in the past where it rises with the CPI, there have been other periods where that has not been the case, where gold has risen while the CPI has actually went down. As you can see in this period right here in 2006, 2007, gold was up quite, substantially year over year that year. But the CPI started to decline, over that same time frame. You can also see other periods where the two have disconnected. in that 1987 to 1990 period, the CPI was actually moving up during that time, but gold was moving down in that time. And it had a little bit of rebound here, but it didn't really take out that prior, high. As you can see, the year over year was, pretty muted at one point, at between 1% to 4%. So we had a high CPI in the 5% range, but gold was muted during that time frame. So there are periods where gold and CPI do correlate with one another, as you see here in the 1970s era, where we had that burst of inflation first in the early 70s and then again in the late 70s, and gold really moved up and down with CPI during that time. But then you see other periods where gold has really disconnected from CPI. So what gives? And then if you scroll over to right now, that same thing happened. We had the highest CPI in 40 years, going back to 1980 or in the late 70s. We all knew this. We were talking about it. This was in the press every single day. CPI hit, 9% year over year. But look what gold was doing. Gold was flat during that time frame. Gold was not responding to that big CPI move at all. And now, oddly enough, CPI is way down. We're way down to 2.9% on a year-over-year basis. And gold is now starting to wake up. So what's going on with that? We all the Fed cut 50 just yesterday. CPI is all but dead. We're back to target, and yet now gold decides to rally. So what's going on there? Here's another chart, another way to look at it. I just have the price of gold relative to CPI year over year. You can see again, CPI is down, right? And the Fed essentially declared victory yesterday, and they cut 50 basis points. But gold has started to wake up out of its coma here that we've been in since really over the past 10 years, 12 years. So we had that big move up throughout the 2000s, through the financial crisis, and through the first, couple of years post-financial crisis. That was a big rally in gold, but then we went into the sideways stagnation, as we're all used to seeing here. We had that big rally up during that inflationary 1970s period. It took a hit, and then it went sideways for the next 2 decades. This was not a 2-decade hold, but this was a 1-decade hold, or a 1.5-decade hold, from 2010 to 2023. And then we had this big move up again. Just when we thought that inflation was defeated and the Fed cuts 50, gold rallies. So what's going on there? So in my view, my answer to this is that gold is not a direct proxy to the CPI. Even though it has been correlated to the CPI in the past, it's not necessarily tied to the CPI. What gold is tied to is, just conceptually speaking, I believe gold is a reflection of forward-looking expectations of liquidity, excess liquidity. So when gold rises, right, that means that we have expectations of rising excess liquidity. And what is excess liquidity? It's simply stated, the supply of money in excess of the demand for money. So when this differential increases, supply of money minus the demand for money, when that differential rises, then we have rising gold prices. When that differential falls, we have falling gold prices. And when that differential stays roughly the same, we have flat gold prices. So going back to that chart, during this 2-decade period of flat gold prices, what that means, in my view, is that the Fed is doing a great job with reading the demand for money. And the demand for money is a function of economic production, GDP, GDI, things like that, industrial production. So, when GDP grows and the money supply grows with it at the right rate, the price of gold stays flat. But when we have rising gold price, that means that the Fed is increasing liquidity beyond the demand for that liquidity. And that's when we have excess liquidity and therefore higher gold price. So now that we have a higher gold price right now, this big breakout over this 10-year, 12-year consolidation period, what this means in my view is that there is an expectation. Because remember, gold is a market, so markets are always forward-looking. So this means that the market believes that there is going to be too much liquidity in the future, going forward 12 to 24 months, possibly more. So what's one way to measure excess liquidity? One way to possibly forecast the direction of future excess liquidity is to look at the trend of the federal government's budget deficit or surplus. This is just my proposal. It's not a statement of fact or anything like that. Just, data that I wanted to share with you, just to present some food for thought. Here's a chart of the fiscal deficit as a percentage of GDP. And as you can see here, going back almost 100 years, this is a chart of the deficit or surplus as a percentage of GDP. And you can see here that we are currently running, now this is updated through 2023 since they only update this annually, as you can see here. This is an annual number. So what I did is I went ahead and calculated the trailing 12 months deficit relative to GDP as of Q2 of 2024, since that's the most recent data that we have. And that number, currently speaking, is minus 7.2%. That 7.2% is the most severe deficit as a percentage of GDP in any non-emergency year. As you can see, that red line is below at any time. You can see these shaded regions are recessions. We have never been running a deficit this large relative to GDP in any bull market year, going back decades, going back a century. And this time was not a recession, as you can see, but we all know, anyone that knows anything about history, what was happening in 1944, right? That was the height of Nazi Germany, and we were entering in perhaps the worst global conflict in modern civilized history. And so that was an emergency year, even though it's not technically a recession. Because, again, wartime spending actually boosted GDP at that time. And so by the classical definition of recession, right, by, measures of GDP, by measures of industrial production, by measures of retail sales, by measures of unemployment, we were not in recession during that time, but that was a emergency year. That's why I didn't use non-recessionary in my terminology. I used non-emergency. So emergency can be a recession, and emergency can be a natural disaster like COVID. Emergency can be, the breakout of a major war. An emergency could be a major attack on our country, like what happened in Pearl Harbor. So that was definitely an emergency. COVID was an emergency. And 2008 was an emergency and recession together. And yet here we are at 7.2%. This has been the largest deficit in any non-emergency year. This is a lot of government spending, a lot of deficit spending, because this is money that's not funded by tax revenue. This is money that is spent by borrowing and adding to the national debt in order to spend today. So when this happens, in my view, when we ride up the deficit, that necessarily means that at some point, that deficit will need to be monetized, and that means future excess liquidity from the Fed in order to make sure that the government can borrow under reasonable terms. So if you chart this, look at the amazing inverse relationship that gold has with the deficit. So I went ahead and calculated the trailing 12-month deficit on a monthly basis versus the price of gold. And the price of gold here you can see in the color gold, and the trailing 12-month deficit in this black line here. And as you can see, throughout most of the last 45 years of our history, we've been running a deficit pretty much every year. The only rare exception was that, the late 1990s during Clinton's second term, where we ran a budget surplus. That was an amazing time. We haven't had a surplus since then. We've only ran a deficit. And as you can see, the bigger the deficit, the higher the price of gold. And the smaller the deficit, the lower the price of gold. So we saw during that 2010s, early part of the 2010s, during the second term of Obama, as we stabilized the financial system, as we stabilized the economy, we got back to growth, and the government was able to trim the deficit quite substantially. We went from a 1.5 trillion deficit in the aftermath of the great financial crisis. And, government spending did not grow as fast as government tax revenue, which is a good thing. And so we trimmed the deficit quite materially from 1.5 trillion to 500 billion. So as we saw during that time, the deficit relative to GDP, was much more tame, much more palatable. Went back well below 5%, is closer to 4%. Still a deficit, but, manageable. And so the price of gold tanked under that expectation, right? It started to move in advance of that. But now look what's happened since then. Really since the end of Obama's term, we were already going down. And into Trump's first term, that deficit was getting deeper and deeper. And then COVID happened, and then bam, right? We ran, pretty much the wildest deficit that we've seen in a long, long time. Really going back to World War II. That was the biggest deficit since World War II. But, that's understandable because COVID was a national emergency. And then, the subsequent period after COVID, we had a big bounce back. And so gold did take a hit briefly, thinking that, we might actually be getting back to fiscal sanity. But that never happened. And, ever since then, we have had supposedly a very strong economy, but we never trimmed the deficit. Every single time that we have had a strong economy like we did throughout the 2010s, we were able to trim the deficit, except, again, during that period in the late 2010s. And right now, look at the deficit today. We're running a deficit north of $2 trillion over the past 12 months. This is through August of 2024. So this, to me, is telling me that, with this big breakout in the price of gold, what does that mean? As deficits rise, liquidity must eventually rise to accommodate it. And I ran the regression, and gold has had a 70%, a 0.70 R, meaning correlation coefficient, to the budget deficit or surplus. And that's a leading correlation too, because again, gold is a market, so it's going to move ahead of any changes. As you saw here, it topped out and started to, decline, as the budget deficit was being trimmed in the aftermath of the great financial crisis. And then the opposite started to happen. The gold price started to move up again as deficits started to get back into deeper and deeper red ink. And again, we just saw, the deficit tank once again. Just when we thought that we were getting back to fiscal sanity with growth again, the government has been on a spending binge, partially because of the great and exponentially rising interest expense, which is now, the second biggest line item on the federal budget behind Social Security, but ahead of defense and Medicare, which is, amazing in and of itself. That is obviously a cause for concern. But as deficits rise, liquidity must also rise to accommodate it. And so that's why I believe that with gold rising materially over the past year, with a big breakout over that 12-year consolidation range, right? That to me is significant, and it's telling me that it's forecasting increasing fiscal deficits, which, as I said, has already crossed 2 trillion or 7.2% of GDP. That is unprecedented. Again, we've never ran a deficit this large outside of an emergency, a national emergency like World War II, or like the Great Financial Crisis, or like COVID. But over in the last 100 years, we've never ran a deficit this large outside of COVID, the Great Financial Crisis, a time when entire banks were crumbling before our eyes, and here in 1943, when when Jewish people were being exterminated, and we had to enter that conflict to stop it. This is a lot. This is substantial in my view, and unless if this changes, this is not sustainable. And gold has finally made a decision, a decisive move, that this is not going to get better anytime soon, that this is going to get worse. Again, this 70% leading correlation is significant. So again, to summarize, when gold is rising, it means that there's going to be too much liquidity. When gold is falling, there's not enough liquidity. And when the gold is flat, there's well-balanced liquidity. So when gold is flat over extended periods of time, it means that the money supply is well-balanced with credit demand. And I believe that true bull markets are when stocks rise, while gold being mostly flat, because that tells you that the supply of money is well-balanced with the demand for money, with GDP, right? You don't want falling gold either for too long of a time frame, because that means that money supply is actually strangling growth. It's not allowing for growth to go up. So we want growth and we want liquidity to balance and accommodate that growth. But we don't want excess liquidity, and we don't want a shortfall of liquidity either. We want well-balanced liquidity, and that's what we had throughout the 1980s and 1990s. Going back to that chart, this was a phenomenal time. As gold price was stable, that means liquidity, that means the Fed was doing its job correctly at gauging how much liquidity was needed. And, Alan Greenspan, if you know a little bit about him, he was a gold sort of watcher. That was his background. He believed in the value of gold and looking at and stabilizing the dollar price of gold. When gold is stable relative to the dollar, then that means that the Fed is doing a good job with setting monetary policy, with setting interest rates, and with determining the level of liquidity. That allows for maximum growth without overinvestment, without other types of things that happen that lead to the boom and bust cycle. So again, I believe that with gold rising materially over the past year, I think it's forecasting increasing deficits. And, a deficit, right, or a surplus is simply tax revenue minus government spending. So right now, since we're running a deficit of $2 trillion, that means the government spent $2 trillion more than what they brought in from tax revenue. So the gold rally suggests that the deficit will continue to swell, which means that this can happen in one of two ways. Either gold is forecasting that government spending is going to rise relative to tax revenue, meaning they're going to spend more on interest, on stimulus, on other programs, on other subsidies and handouts and other things like that. Meaning government spending on an absolute basis will rise faster than tax revenue. Or it could mean that government spending will be mostly flat. It'll continue to rise just because it has to rise due to mandatory spending growth, but it won't rise because of new spending programs. But we could see a deficit increase if we have falling tax revenue. And tax revenue can fall due to recession. or we have all of the above. So we can have a rising deficit due to one of these two or both of them at the same time. So the price of gold rising could mean that either we get a rising recession on the horizon, which means falling tax revenue while government spending continues unabated. That increases the deficit, which boosts up the gold price. But there's also a door being left open for another outcome, which is rising deficit spending, which again requires higher liquidity. So I believe either Trump or Harris may bring with them higher deficits. Harris, might bring with her higher deficits due to higher government spending, and Trump might bring a higher deficit with him due to a recession, or both of them could bring with them a recession. I'm not really sure which one is which, and I'm not convinced that either one of them is going to solve the problem of the deficit and of a potential recession on the horizon. So I think that despite yesterday's 50 basis point rate cut by the Fed and today's strong market rally, I think I continue to advocate and strongly urge caution and a repositioning of assets into durable quality businesses. Again, this is my recommendation. This is what I've been sticking through, especially since the July jobs report. I still think that recession is the base case as we get the job market deteriorate quite rapidly. And we're going to get back to that on the next update here, because I think that private sector job formation is right now at the slowest pace in any non-recessionary year. We've seen that confirmed through the August jobs report, and we will see what happens again with the September report, but the trend is not good. The unemployment rate has crossed thresholds of recession. The, U2 unemployment rate, which uses permanent job losers, that has crossed thresholds consistent with recessions in the past. Recessions are usually not detectable in the early innings. And I believe that we have, satisfied certain criteria that suggest that we are in the early innings of recession. So that's why, in my view, the rising gold price is signaling falling tax revenue, higher deficits, and therefore, due to recession. A recession leads to falling tax revenue, which then leads to higher deficits, which then need to be monetized with greater excess liquidity. And that's what the Fed usually fights recessions with, excess liquidity. So I continue to advocate and urge caution, and I believe that right now, the Zacks Earning Certain proxy is the best place to park money, to invest money into. Again, the Zacks Earning Certain proxy is our portfolio of recession-resistant, durable, moat-protected, low-volatility, steady compound growth companies. Companies like you see here: Costco, Intercontinental Exchange, Amgen, Mettler Toledo. Phenomenal businesses, companies that are unaffected by the business cycle, companies that continue to produce products and services that are required, not nice to have, not discretionary. You can see the earnings are durable over multiple time frames, different market cycles. And again, this is the aggregate portfolio built for long-term durability. So I hope you found this helpful. If you have any questions, if you have any feedback, I'd love to hear from you. This is just my thoughts that I'm sharing with you out loud. If you have any comments or feedback, if you have any disagreements, or if you have any charts to share, I'd love to hear from you. Please, with any of those, comments or questions, give us a call, 1-866-794-6065, or send us an email to strategycall@zackspro.com. Thanks, everyone, and see you soon on the next one. Take care.